Fiscal policy. Key features of fiscal policy. Fiscal policy, or sometimes called budgetary policy, involves government spending, that is public expenditure, and taxation. It can be used to influence the economy as a whole, that's on a macroeconomic level, or individual firms and people, i.e. microeconomic effects. Fiscal policy can be used to stimulate, that's influence, aggregate demand. Reflationary fiscal policy, sometimes called expansionary or loose fiscal policy, involves boosting aggregate demand, causing the AD to shift to the right by increasing government spending or lowering taxes. It's likely to involve a government having a budget deficit, that is, government spending exceeds tax revenue. Deflationary fiscal policy, sometimes called contractionary or tight fiscal policy, involves reducing aggregate demand, that is, causing the AD to shift to the left. By reducing government spending or increasing taxes, it's likely to involve a government having a budget surplus, that is, government spending exceeding tax revenue. It's likely to be used during a recession or when there's a negative output gap. It will increase economic growth and reduce unemployment, but it'll also increase inflation and worsen the current account of the balance of payments, because as income increasing, more is spent on imports. A deflationary fiscal policy is likely to be used during a boom or when there is a positive output gap. It will reduce economic growth and increase unemployment, but it also will reduce price levels and improve the current account of the balance of payments, because as income falls, less is spent on imports. A government's fiscal stance or budget decision describes whether their policy is reflationary, deflationary, or neither. If a government has a neutral stance, then government spending and taxation has no effect on aggregate demand. That is, no net effect on aggregate demand. Automatic stabilisers. Some of the government's fiscal policy may automatically react to changes in the economic cycle. During a recession, government spending will increase because the government will pay out more benefits, for example, job seekers' allowance. The government will also receive less tax revenue, e.g. due to unemployment. These automatic stabilisers reduce the problems a recession causes, but at the expense of creating a budget deficit. During a boom, the automatic stabilisers create a budget surplus as tax revenue increases and government spending on benefits falls. Discretionary policy. This is where governments deliberately change their level of spending and tax. At any given point, a government might choose to spend on improving the country's infrastructure or services and increase taxes to pay for it. On other occasions, the government might take action because of the economic situation. For example, during a recession, the government might spend more and cut taxes to stimulate aggregate demand. Cyclical and structural budget positions are different. A structural budget position is a government's long-term fiscal stance. This means their budget position over a whole period of the economic cycle, including booms and/or recessions. A cyclical budget position is a government's fiscal stance in the short term. This is affected by where the economy is in the economic cycle. Automatic stabilisers are likely to create a surplus, i.e. a contractionary budget position during a boom, and a deficit, i.e. an expansionary budget position will occur during a recession. A budget deficit caused by an expansionary budget position is known as a cyclical budget deficit. This will be balanced out by a budget surplus during boom times. That is when the cyclical budget position is contractionary. A budget deficit caused by an expansionary structural budget position, where spending is more than revenue in the long term, will add to national debt. This is called a structural budget deficit. Government spending types. Government spending can be split into current expenditure, capital expenditure, and transfer payments. Current expenditure refers to repeated spending on things which are used up quickly. For example, wages, textbooks for school, gowns for medical staff. Capital expenditure is spent on assets, that's infrastructure, and will last a long time. Transfer payments, on the other hand, are to do with welfare payments, such as job seekers' allowance or disability payments. The government may have a budget position on current expenditure which is different from their overall position. For example, they may want current expenditure to be funded from revenue, but will be willing to borrow for capital expenditure, such as was the case with the UK's Golden Rule prior to 2008. So, the budget position on current expenditure would be neutral or contractionary, but their overall position may be expansionary because of their capital expenditure. Different types of tax systems. Taxes should be cheap to collect, easy to pay, and hard to avoid, and they shouldn't create any undesirable disincentives, e.g., disencouraging people from working or from saving. A good tax will have all these aforementioned features. On top of this, governments may want taxes to achieve horizontal and vertical equity. Horizontal equity will mean that people who have similar incomes and ability to pay taxes should pay the same amount of tax. Vertical equity will mean that any people who have higher incomes and a greater ability to pay taxes should pay more than those on lower incomes with less ability to pay taxes. Governments may also want taxes that promote equality in the economy. This might involve using taxes to reduce major differences in people's disposable income, or to raise revenue to pay for benefits and for the state provision of services. Governments raise tax revenue through direct taxation, e.g. income tax and corporation tax, and also through indirect taxation, for instance VAT or excise duties. They also use different tax systems to achieve different economic objectives. The ones you need to know are progressive taxation, regressive taxation, and proportional taxation. Progressive taxation is where an individual's taxes rise as a percentage of their income. As I repeat, progressive taxation is when an individual's taxes rise, again, as a percentage of their income, as their income rises, and is often used to redistribute income and reduce poverty. The government can use the tax revenue from those on high incomes and redistribute it to those on low incomes in the form of benefits or state-provided merit goods, e.g. healthcare or education. This will increase equality. Progressive taxation follows the ability to pay principle, i.e. that tax achieves vertical equity. Regressive taxation is where an individual's taxes fall as a percentage of their income despite their incomes increasing, and they're used by governments to encourage supply-side growth. By reducing the taxes of the rich, the government will hope that the economy will benefit from a trickle-down effect. A regressive tax system gives people more of an incentive to work harder and earn more income, but it may increase inequality. At this point, it's worth paying attention to the Laffer curve. Supply-side economists argue that increasing direct taxes creates a disincentive to work and therefore reduces a government's tax revenue. This is shown on the Laffer curve. More accurately, on the right-hand side of the Laffer curve, which I've noted in red. Also, the Laffer curve shows that as taxes increase, eventually this will lead to a decline in tax revenue because people will have less incentive to work. That said, you can see that at a rate of 0% tax, so here 0% tax, zero tax revenue is collected. However, up to a certain point, and I've got the question mark here because it's arbitrary what this figure is, you can see that an increase in tax rate will lead to more tax revenue. So the problem for governments is that they are unsure whether they are on the red side, meaning that if they increase the tax rate, at this point here, they increase the tax rate, okay, they are going to lead to having, it's going to lead them to having decreased tax revenue. However, if they're here, an increase in the tax rate is going to bring about an increase in tax revenue. So to reiterate, we don't know, or rather the government will not know whether it's on the left or the right hand side of of the Laffer curve. It's a key evaluative point. A proportional tax, more commonly called a flat tax, is where everyone pays the same proportion of tax regardless of their income level. This tax system can achieve horizontal equity, but setting a fair tax rate to apply to all members of society is difficult. For example, a 25% tax on income might be too high for those on lower incomes to afford, and it might not raise enough revenue from those on higher incomes for the government to be able to pay for all the public goods and services it provides. Supporters, however, of a flat tax argue that it can simplify the tax system, reducing the incentive to evade and avoid paying taxes, and increase the incentive to earn more. It's suggested that flat taxes often charge higher earners less than variable taxes, hence why the evasion and avoidance is less likely to occur. That said, flat rate tax systems may bring in less tax overall than variable tax systems. Flat rate tax systems also don't have vertical equity, but they can be made more progressive by having a tax-free allowance. That is, where you don't pay any tax until you earn a certain amount. The UK government uses various different taxes. In the UK, there's a sales tax on most products, known as VAT, Value Added Tax. VAT is a proportional tax. It's a fixed percentage regardless of the selling price of the product. However, it can be seen as a regressive tax. This is because the percentage of total income that the rich spend is less than that of the poor, e.g., because the rich can afford to save more of their income. So that means the percentage of total income that the rich spend on VAT will be less than it is for the poor. A more progressive system of that might be to tax luxury goods at a higher rate. This isn't currently used, but it is a good recommendation to resolve the regressive element. It's argued that the UK has a progressive income tax system. There's a tax-free allowance that will become £12,500 in 2019. And then individuals on low to middle income have their extra income over the allowance taxed at 20%. Those on a high income are taxed at 40% on their extra income over a certain threshold, and those on a very high income are taxed at 45% over the threshold. At the end of this video, I will provide you with a numerical example of how income tax is calculated. It also needs to be pointed out, or rather argued, that the UK tax system can be seen as regressive, because if you consider direct and indirect taxes together, the lowest earners in the UK economy have to pay a higher proportion of their income as tax than higher earners do. The size of government spending can be affected by several things. The size and structure of a country's population will affect levels of government spending. For example, a country with a large population may require greater levels of government spending than a country with a small population, and a country with an ageing population will have greater demand for state-funded healthcare. Government policies on inequality, poverty and the redistribution of income will alter the amount of government spending. This might vary from government to government depending on their political views and the degree to which they perceive that market failure is taking place. For instance, a government that wants to redistribute income may spend more on benefits. The fiscal policies governments use to tackle certain problems in a country will also have an effect. During a recession, a government may increase public spending to encourage growth and reduce unemployment. But if these policies lead to a large national debt, then the government may introduce austerity measures and severely reduce their spending. Large budget deficits can cause big problems. A budget deficit must be paid for by public sector borrowing so that the government can spend more money than it receives in revenue. This budget deficit is also known as public sector net borrowing. It's the borrowing that a government has in a single year. The national debt is an accumulation of these budget deficits. In the UK, the government can borrow the money it needs from UK banks, which will create deposits that the government can spend. It can also borrow money from the private sector by selling bonds, which the government will pay off over a period of time, or it can borrow from foreign financial markets. This kind of borrowing is fine in the short run, especially if the borrowed money is used to stimulate demand in the country, but there will be problems if there is excessive borrowing. Excessive borrowing could cause demand pull inflation, partly due to the fact the government's borrowing increases the money supply, so there is more money in the economy than can be matched by output. As borrowing may cause inflation, it can also lead to a rise in interest rates to curb the inflation. Higher interest rates will discourage investment by firms and make a country's currency rise in value, meaning that its exports are less price competitive. Continued government borrowing will increase a country's national debt. A large and long-term national debt can cause several problems too. First, if a country's debt becomes very large, then it may cause firms and foreign countries to stop lending money to that country's government. This will constrain the country's ability to grow in future. Future taxpayers will be left with large interest payments on debt to pay off. Debt payments have an opportunity cost, as future governments may have to cut spending to pay off a debt, which may harm economic growth. So a second reason, future taxpayers will be left with large interest repayments. The third reason, a large national debt suggests there's been excessive borrowing, which causes inflation and interest rates to rise, as we've already mentioned. It also suggests that public spending is very large, which may crowd out private sector spending, although if government spending boosts the economy, there may be crowding in instead. That is, public sector spending may increase private sector spending. Firms will invest more if the economy is growing quickly. Finally, a country with large debt is less attractive to foreign direct investment, as foreign countries will be uncertain how the debtor's nation's economy will do in the future and whether it will be a good bet for investment. So this next part is very important. It's regarding methods to correct the budget deficit. Methods to correct a budget deficit will depend on what kind of budget deficit it is. So for instance, a cyclical budget deficit is caused by recessions and comes about due to a government's automatic stabilisers, that is when government spending on benefits increases and tax revenue falls, when there is a huge negative output gap. This kind of deficit will be corrected when the economy recovers again and the negative output gap shrinks. The deficit will then be replaced by a surplus. However, a structural budget deficit is caused by excessive borrowing. It's much harder to solve. To cure this problem, governments will have to raise taxes and reduce public spending so that they can pay off their debt. These are known as austerity measures. However, these actions could harm economic growth and cause other problems. For example, increased income inequalities in society as welfare payments are reduced. Budget surpluses are not ideal either. A budget surplus is generally more desirable than a budget deficit. However, it's not always a good thing. A budget surplus might suggest that taxes are too high or that governments aren't spending enough on the economy. Both of these things could harm or constrain economic growth. For instance, if you are not spending enough, it might mean that you're underspending on education and therefore long-run aggregate supply will not shift to the right in the future. Lowering taxes or increasing government spending would correct a budget surplus. Governments follow fiscal rules to avoid overspending. The UK government first brought in fiscal rules in 1997. One of these was the Golden Rule. Over the economic cycle, the government can borrow to invest in things like infrastructure, that is capital expenditure, which should generate longer-term growth, but cannot borrow to fund current expenditure, e.g., for example, teachers' wages. Following the fiscal rules like these should help to prevent a government from continuously borrowing and overspending to promote growth, which increases national debt and inflation. It also helps governments to achieve economic stability as it'll avoid uncertainty and fluctuating inflation. Fiscal rules can also influence the behaviour of business and consumers by increasing confidence in future economic stability. For instance, consumers may be more willing to spend and firms may increase investment if they're confident in the country's economic stability. However, this will only work if there is a belief that governments will keep to the rules they've set. For example, there is disagreement over whether the Golden Rule was actually being followed between 1997 and the 2008 financial crisis, as it's not clear how an economic cycle is defined. Incidentally, this rule was abandoned in 2008. In 2010, the UK government created the Office for Budget Responsibility, known as the OBR. It's an independent body, which means the government has no influence over it. Beg your pardon. It's tasked with publishing reports that analyse UK government's public spending, taxation, and government predictions on future spending. Secondly, it assesses the performance of the government against the fiscal targets it set for itself. Thirdly, it uses long-term projections to analyse how sustainable government spending and revenue is. By doing this, the OBR helps the government to keep its fiscal policy under control. Governments use fiscal policy also to tackle poverty. Fiscal policy can be used to reduce poverty in a country. There are three key ways a government can do this. That's through benefits, provision of certain goods and services, and progressive taxation. Government spending on benefits, e.g. job seekers allowance, pensions and disability benefits, is a way of helping those who are unemployed or unable to work and thus reduces absolute poverty. A government can also spend its tax revenue to provide goods and services such as free health care or education to enable those who are suffering from poverty to have access to these things. In other words, correct market failure, the under-provision of merit goods. Furthermore, by providing some goods and services to poorer members of society, a government will be investing in the improvement of its country's human capital. This spending may make labour, that is one of the factors of production, much more productive. Progressive taxation may reduce relative poverty by narrowing the gaps between people's disposable income and the revenue raised can pay for benefits and the state provision of goods and services. On top of this, governments could provide tax cuts and discounts for the poor. Finally, if fiscal policy creates growth, this may reduce both relative and absolute poverty. Greater economic growth will mean more jobs, higher incomes, and a better standard of living. Here I've noted the main sources of tax revenue in the UK. Our main source of revenue comes from income tax. That is, of all our tax revenue, 30% comes from the collection of income tax. This page should be relatively self-explanatory. Please note at the bottom that council tax and business rates are not included as this goes to local government. Now here are the main areas of government spending. You can see that 40% of all our spending goes on social support. You may be surprised to see that education as a percentage has a lot less spent on it than social support. Just 15% of government spending goes on education. You can see debt interest on there. That's to service our budget deficit. That's our public sector net cash requirement, the loans and bonds that we take out in order to fund our budget deficits. So I'm just going to put on the end of this video a couple of evaluative points for you to consider. The first one is the effectiveness of discretionary fiscal policy. So I would pause the video now and have a look at some of these. As promised, here is how income tax is calculated. So it should be noted that between £0 and £11,500, at least for the financial year 2017 to 2018, that the first £11,500 is tax-free. Thus 20% tax is paid on £22,000. That is the 33,500 minus the 11,500. Overall, you can see that how this affects various groups. So you can see that the travel agent obviously has a much lower tax bill than the financial executive. Okay. These bands here on the left, tax-free allowance, lower income tax, middle income tax, high income tax, we refer to these as marginal tax rates. Okay, so you can see there that how they're calculated. You can pause the screen as you see fit for those. And that's basically us done with regards to fiscal policy. Thank you for listening.